This lesson will focus on international capital flows and the balance of payments model. So first of all, what are international capital flows? When we talk about international capital flows, we are talking about money, not capital goods. So this is the first confusing part, because typically when we use the word capital, we're talking about machinery, tools, and equipment. But when it comes to international flows of money, we call them capital flows. So you want to keep in mind that particular term. When you see international capital flows or financial flows, we're talking about money moving across borders. So why does money move across borders? Well, for example, when Americans buy imported goods, like German cars, capital or money will flow toward Germany. So the producer in Germany is going to receive a payment, and the American consumer is going to receive the car. Same thing happens when Germans buy imported goods from the United States, like American wheat. The money will flow toward the United States, but the wheat or the product will flow towards Germany. Now, just a side note, you may not realize this if you buy a German car, because you might buy it at an auto dealer within the United States. Nonetheless, that auto dealer is going to transfer a significant portion of your payment back to Germany. So the money will leave the country even if you don't actually see that happening. So when we come to look at the balance of payments, there are actually two accounts. One is called the current account, and the other is called the financial account, or historically it was called the capital account. So for easier terminology now, it's called the financial account, but you might occasionally see reference to the capital account. So what is the current account? The current account is any transactions that do not create liabilities, meaning there's no ongoing relationship, there's no expectation of future payment later. So for example, a farmer in Iowa sells wheat to a food processor in China. The food processor pays for that wheat, and that transaction is over. That is the end of the story. So many of the transactions that happen internationally happen in what's called the current account. The financial account, on the other hand, includes transactions that do create liabilities. So there's an ongoing relationship established. For example, if GE or General Electric sells a bond to an investor in Japan, that is not a one and done kind of transaction. General Electric will actually have to pay interest and repay principal in the future. So that relationship between the American company and the investor in Japan is an ongoing one. So let's look at what counts in each of these. First of all, most of what we talk about when we talk about trade is in the current account. So you'll notice that imports are here and exports are here. All the goods we buy from other countries, all the American goods that are exported to other countries. Also tourism. If somebody from Japan comes on vacation in the United States, what they spend counts in the current account. If you go on vacation to, say, Amsterdam, what you spend there counts in the current account. So most of what we talk about is there. We're going to come back to this one, the net income on foreign investments, in a moment. Let's skip ahead to net transfer payments. That's where you just send money to somebody. Let's say you want to help with famine relief efforts in Africa, or you want to help people in Haiti and you just send cash. That would be considered a transfer payment. That's also in the current account. So many of the ways that we spend money and trade with other countries are current account. Financial account is just as large, but it's not nearly as visible to most Americans. So the financial account counts when you buy a real asset abroad. So for example, if I decided to buy a hotel in Costa Rica, or even a home in Costa Rica, that would count in the financial account. It's an ongoing relationship. Now I actually own something of value in Costa Rica. Purchases of financial assets in other countries work the same way. So I mentioned before, a Japanese investor might buy a General Electric bond. That would be a financial account transaction. So you can buy a hotel, you can buy a factory, you can buy a home, or you can buy stocks and bonds issued by foreign governments or foreign companies. So let's go back over here. This net income on foreign investments, that is what happens after you've bought one of these things. So let's say I bought a hotel in Costa Rica. Now I'm going to be earning income off of that hotel as guests come and visit and they pay for their stay. That income that I earn goes into the current account. So the initial purchase is financial account, but the income I earn off of it is current account. So one of the interesting pieces that people often don't realize is that the current account and the financial account balance out. Meaning, we often talk about having a trade deficit in the United States, but what we mean is we have a trade deficit in the current account. The money that leaves the United States, for example, our imbalance of payments with China. We import more from China than we export to China, which means we are sending a lot of money to China in exchange for things like t-shirts and toys. That money doesn't stay in China. It finds its way back to the United States through the financial account. So people in China buy U.S. government bonds, and that's the way the money comes back. So if we have a $100 million trade deficit in the current account, we would have a $100 million surplus in the financial account. They may not be exactly equal, but any imbalance, which is really less than like 3% of the total size of those accounts, comes out as a change in official reserves or government reserves. There's one other piece to this to know, and by the way, you'll be doing practice problems to help reinforce this, but the other piece to know is whether transactions count as credits or debits in these accounts. So the way to figure this out is to determine who is getting paid. If the payment is made to somebody in the U.S., so if the person being paid is a U.S. company, then it would be considered a credit to the U.S. in the balance of payments. But let's say that an American buys a German car, the person getting paid is the German car company, so this becomes a debit in the U.S. balance of payments. Okay, it's not really a matter of what currency is used, because currencies are being traded all the time, but it's a matter of who is the ultimate receiver, because the person who's the ultimate receiver is ultimately going to be paid in their own currency, and that's why it's considered a debit if it's used a foreign currency. We'll do practice questions in class to review this.